We're live. Well, thank you everyone for joining us this morning. Hope everyone's having a great Thursday. Most of all of you know me, but for those who don't, my name is Andy Langsford. I'll be moderating the event today. The founder of Ventures started the company about 15 years ago, which is a very long time. But today we're going to be talking about, is now the time to invest in real estate, or should you wait? That's the question. So we're just a couple of housekeeping items. We're actually streaming live on Facebook and YouTube. So if anyone who's watching, if you're on two or more streaming devices, there'll be about a 5 or 10 second delay. So I'll just mute one or just stick with us on one because of the delay. But also, today is going to be absolutely fantastic. So first, I'm going to start with introducing Greg Russell. Greg is a partner at Peterson Russell Kelly Living Good. Hey, Greg.
Hey, Andy, how's it going?
Going great. How are you, Greg?
I'm doing great.
So Greg is actually a phenomenal attorney. Greg's one of our attorneys, personal attorneys, and we use him for a bunch of different things. Greg offers a broad-based practice, including real estate syndication. He's actually a phenomenal syndication attorney, general counsel representation, mergers and acquisitions, corporate finance, succession, exit planning matters, and an all-around great guy.
Yeah, try and keep everybody out of trouble. That's my goal.
Yes, that's a good thing. And Greg's in Chicago.
I am normally in Seattle, but today I am talking to you from Chicago.
Yes. And next is Michael Gaberman. Michael's a private banker with Washington Trust Bank. Michael, I was gonna end with this, but I'm gonna start with this. Michael's actually a phenomenal tennis player. That's a side note. But Michael's with Washington Trust Bank. His extensive background is across commercial, industrial lending, ensures his ability to provide a complete package of tailoring banking services. Washington Trust is notably one of the premier private banks in the Northwest. Really, their service is unmatched. They're one of the top banks in the Northwest, very well known. Thanks for joining, Michael.
Hi, everybody.
Appreciate you taking the time. And then next is Brian Scalabrini, AKA the White Mamba. Brian's a former NBA basketball player, won a NBA championship with the Boston Celtics. Current radio host and current analyst for the Boston Celtics, and longtime real estate investor. Brian and I partnered a couple of years ago. We built the 119 unit Adriana. And for those of you who don't know, the Adriana is actually named after Brian's two daughters, Adria and Eliana. So it's we talked about what should we name the building, and then it's really a fitting name to a great building.
Well, thanks for having me, Andy.
Yes, thanks for joining, Brian. And Brian recently challenged me to a tennis match on Zoom. He said, if I'm going to do this, you need to post your match on Zoom, your next match. So, but it's not going to be basketball. That's for sure.
I think you'd lose, Andy, if you played him in basketball. The question would be, would you get a point, right?
Yeah, something's zero.
Yeah, like Andy beat me. I didn't score a point in an hour and a half of tennis. So if we played basketball, I would make sure he did not score a point. I wouldn't take it lightly.
Brian would not take it lightly on me. I can guarantee that. Well, great, everyone. We're just we're going to jump right in with questions. And also, actually, for questions, we're on Facebook and YouTube. As I mentioned, we got Jody, one of our brokers, is manning YouTube. John is on Facebook, manning that. So if you have any questions on either one of those platforms, just send them in. If you're on Zoom, send them in as well. We're going to have a brief Q&A session after the event. But I'm just going to jump right in. So, Michael, I'm going to start with you for the main topic of this webinar. We're going to jump right in. Is now a good time to invest in real estate?
Well, there's always a time to invest in real estate is a better way of saying it. And if we just flash back to '08 and '09, a lot of the people that not only jumped in then made, unbelievable double-digit returns because the market worked in their favor, principally because people needed to unload assets. And if everybody recalls, the banks were calling in loans at that time, and people were selling A assets to keep their B and C assets. And a lot of real estate investors were able to buy those A assets at large discounts and hold on to those and, monetize that gain over the last 10, 12 years. So there's always a time to buy real estate. Real estate's a great hedge to have with your securities portfolio and to have with your income, as Greg does as his law firm and Brian does with his broadcasting. It's part of a three-legged stool. So if you don't have it, I encourage you to have it. I think every smart investor has it, because times like today where things are very uncertain, assuming that the rents are coming in, whether it's a commercial or residential property, it provides some certainty and some comfort to people. And those assets don't get repriced in the market. Your cost base they don't move and fluctuate like other assets do. Andy, go ahead.
Greg, how about you? What are your thoughts?
Yeah, I agree with what Michael said. I mean, about what happened in 2009. That's definitely true, right? I mean, you and I both know a couple of investors who made big plays, right, in certain markets, and that turned out really, really well for them. So I think, there's, for the right opportunity, right? I think there's a lot of good opportunities there in real estate, but you do need to have good capital, right? You need to have some good capital reserves. Either you raise that through it with investors, or you have your own capital that you can deploy if needed. If you have a dip, what happens, right, is in these downturns, the financing is a little tougher, and you can't get, maybe you're not going to have the rent streams, right, as consistently as you would for a little bit. And so you need to be able to buffer those periods with your own capital or investor capital. But other than those two caveats, I think there's always a good opportunity out there, especially in tough economic times.
Mm-hmm. Yeah, mindset is key. I think we lost Michael for a bit, but you're back, Michael. Brian, what are your thoughts on investing now?
Well, I do like that interest rates are down, and that's obviously a bonus, but that's only going to last. You get a loan for a commercial spot, and you get it for 5 or even maybe 10 years locked in at a good rate. So it goes back to what Greg was saying. You better have enough surplus to survive whatever happens in the near future, whether it's, with 40% unemployment or 30% unemployment, whatever it is. We don't know that all those people are going to go back to work. We assume that that's going to happen. But if you're going into commercial real estate and you just get an absolutely phenomenal deal and you get phenomenal interests or financing, now you have to make sure that you could sustain whatever dip happens based on the unemployment or whatever companies, whatever small businesses you have out there that somehow can survive the coronavirus thing. And if it's a restaurant, can they survive with the new social distancing layouts in their restaurants? So those are the type of things that you would have to factor in. But if it's the right deal and you can get distressed assets and you can get good interest rate, I don't see why not.
Yeah, no, that's good. Yeah, good, really good thoughts, Brian. Yeah, rates are low right now. If you can find the right deal, and you can't be over leveraged, like that is key. You cannot be over leveraged in the market right now. And there's going to be opportunities. So, Greg, I'll ask you on asset type. What asset type would you invest in right now in the market? What would you invest in, and what would you stay away from?
As I was going to say, don't invest in hotels right now, but I know you're working on one of those deals, right? So it depends on the deal, right?
The Depends.
like the hospitality industry is just getting crushed right now, right? Which is, you'd think, well, I don't want to buy in that space, but actually that's what Michael was talking about, right? There's an opportunity there, right? If you have the capital and you can come in with a decent offer, a lot of times those properties that are in distress don't have, they can't refinance, their lender, they're out of covenant, right, on some of their loan covenants, and they don't have any capital reserves to fix that, and so they've got to sell, right? And there's an opportunity there. So I think, interestingly enough, you'd think, don't buy into hotels or hospitality, but there are some opportunities there. The other one is apartments. I think especially in core areas like Seattle, the greater Seattle area. Once you get through this pandemic and everybody's kind of back to work, which is maybe a little while, probably is going to be a little while, then these core areas are going to be strong, I think, for apartments. And even in this area, we can talk about it, I suppose, in a bit, but there's most of the apartments are doing okay, right? Some are getting hurt, but a lot of them are doing just fine in the greater Seattle area. So the other one I probably wouldn't jump into is retail. I think that one I'd stay out of for a while. Office, I'd be a little nervous about. I think there's going to be some changes in the office market long term. The right commercial property, like Brian was talking about, that you get a good lockup, a good long-term low interest rate on your financing, and maybe you have some good solid blue chip tenants, commercial tenants, then that can be a really nice investment for the long term. So those are the ones I'm thinking of off the top of my head.
Yeah, no, great comments. Michael, what are your thoughts?
Just backing up on Greg's comments, there's going to be some great discounts on some commercial properties right now. I've got two clients. One is losing a credit tenant, and the other one is gaining the same credit tenant. It's a large healthcare organization, and they're signing a new 10-year lease for the new tenant, and the client that's losing the tenant, they only have 2 years left on their lease. So they're even with the same user, there's opportunities, but the same thing is said. Seattle right now is tough for apartments and any kind of landlord on a residential basis because there's so much going on around the laws and the tenancy and the eviction process. So a lot of people are looking outside of Seattle, the shorelines, the Bellevues, or anywhere around the perimeter because there's a certain level of frustration. I've got a client that's got an apartment building in the U District, literally on the Ave, and he's just tired of dealing with it because, if a client doesn't pay, the law requires him to keep that tenant in there through the spring of 2021 without starting the eviction process. That really can hurt your cash flow. So you don't not just have to look about the economics of the deal, but all the externalities around the property as well, because they are going to come into play over the next year.
Yeah, I think I think Michael's right on that because, the central Seattle and some of these other cities, Chicago is another one that's like that. They've imposed so many restrictions on landlords and their ability to get tenants out in a reasonable period of time that it makes it almost impossible to manage a real estate apartment property in those core markets. So, really pay attention to that. What are the rules around which you're going to have to operate? And I think that's going to retard value in markets like that, like in Seattle, and it's going to help value in the exterior markets that are still strong economy, right? I mean, the greater Seattle market is still a strong economy. Maybe you got to buy an apartment in Bothell instead of in Seattle because you're going to get the same bump from the strong economy, but you're not going to get as negatively impacted by the rules around how you run your apartment.
Greg and Michael, can I ask you, what if you went with, do the rules apply if you go to short-term housing, like 1 month housing or week to week or anything like that? Do the rules still apply to the 2021 eviction?
There's a whole nother set of rules that comes into play on those types of scenarios. And I'm not personally familiar with it, but you can see there's been a blowback for a lot of the short-term housing stuff. This is just a fact point, but I've got a friend here on the island that works for Expedia, and he told me that Expedia's profits are all, about 80% of them are based on their U.S. hotel business company-wide. and they were down significantly. However, their home away model, which is the Airbnb competitor, is up year over year in occupancy over last year, which you would think.
Hey, Michael.
Michael went to like COVID land on as far as his internet connection, I think. So he's out of luck there. One of the challenges is, like, I've got a couple clients that are in that space, right, and providing like
that's right now
sorry, Michael.
It's back.
The engine inside of Expedia is sorry.
Yeah, Michael, we're not hearing you. You're jammed up. But I would say, looking at finding a way to work around that, right, and those issues. Short-term rentals are good options, but like City of Seattle, for example, has a pretty strong set of rules that limit what you can do with short-term rentals, and they've applied similar rules, at least in Seattle, to those as they have to the regular apartment. So it doesn't help you, and Brian, unfortunately, you still get stuck with a lot of those same rules in that area.
Yeah, so the two things I'd stay away from: bars and clubs. I just don't understand in the new world that we live in, how those come back. I think restaurants will, but I don't see how being, shoulder to shoulder at a bar, trying to get the guy to serve you a drink when there's people I just don't see how that survives and same thing with the club. So if you guys want to know, stay away from those.
Yeah, good thoughts. I mean, really good thoughts. That's true. I mean, anything that where you're shoulder to shoulder, I think that's going to be a concern for people for the next couple of years at least. So I think that's a valid point. And I know, yeah, the Seattle multifamily market there is concern with the evictions and that Seattle market. Right, landlords are looking at that, especially smaller landlords who own a 4 or a 5 unit building or a 6 unit. Those smaller landlords, and they can't evict a tenant who can't pay rent. When you have 1 or 2 tenants who aren't paying rent on a 6 unit building, and it's a smaller landlord, those people they're getting hurt right now. So on a lot of the larger multifamily projects, 100 plus. Rent collections, I've been on the phone a lot, like, hey, what are you seeing in the market? And collections overall are actually pretty good. Like, it's 90 to 95%. So, but it depends on the location. And Seattle is being hit. Greg, that's a very good point on those outer markets are as a result. So next question. Greg, I'll start with you. Is COVID-19? We've seen our entire country shut down by the virus for the past few months. How do you think our market's going to be affected going into Q3 and Q4, basically the end of the year? What's going to happen come November?
Yeah, I think it's going to all depend on jobs, to be honest with you, right? If we still have, like Brian mentioned earlier, if we still have a huge unemployment, I think market's going to continue to struggle. I think, the apartment markets will still struggle a little bit. I think the office and certainly retail will struggle. So it depends on jobs. And if we're able to get people opened up and back to work and rehiring a lot of those people, then I think we'll be in pretty good shape. I think Seattle area is well positioned for that because it's very heavy tech. I think Boeing's going to take a big hit, obviously, and that's going to create some problems. But by and large, as long as there's still people hiring, which Amazon's hiring like crazy, Microsoft is still hiring, from what I understand. A lot of the tech companies are still hiring, so that's going to help us out a big time here. Other markets around the country, I think, will be interesting to see. Like I was mentioning to you guys before the webinar started, that I was in Indiana yesterday. So I'm in Chicago today, but I was in Indiana yesterday, and Indiana has opened up. And so you could go into restaurants. There was a workout facility that was next to a restaurant where we were eating, and it was full, right? People were going in and out of there like crazy, and so, that you could see their economy was starting to kind of recover and people were doing better. You went into the stores, the store, a lot of the stores were open. You had to wear a mask and stuff like that, but basically they were open for business. And so you were seeing the economy start to come back. And I think if a lot of the other parts of the country do the same, there's going to be some challenges with, infections and spread of the COVID-19 disease. But I think that's what's going to be needed to get the economy back. And if that happens, then I think, the fourth quarter is going to look a lot better. If that doesn't happen as quickly as we'd like, then I think you're looking at more like a first quarter, second quarter next year before we get back to more of a normal economy. You're on mute, Andy.
Sorry, Brian, any thoughts on your end?
Yeah, I mean, I would just be guessing and just being completely transparent. I don't know. In some sense, I feel like Indiana, if that's good news to hear that people are starting to go back to normal life or whatever we consider normal life moving forward. But it's so funny. You talk to people and it's a divide to me right down the middle. Some people are like, yeah, we need to get back. We need to start living our life. We need to get our economy back. And by doing that, we need to go out to restaurants because there's a lot of restaurant workers and all that. And that's how we're going to start this thing in the right direction. But a lot of people I know who own businesses are saying, you know what, we had too many people to begin with. And I just realized that I can get rid of 20% of my employees and I can still be fine, which is a little bit of a dangerous situation moving forward. Also, I'm sure a lot of people, me included, I like being home. It's fun. It's like I can do whatever I want. I can jump on Zoom calls and all that stuff. But a lot of people are going to think that is going to be okay. So if you could do your job from home on Zoom calls, do you need a 7-story, 200,000 square foot office building? And if those aren't being filled, then what's the trickle down effect of that? So I'm kind of cautious about what I think the coronavirus is going to do for businesses moving forward. And I would think quarter one of next year, I don't know if it's going to be good. I think we'll have an idea of what it looks like. I don't think we can make any kind of assumptions on third quarter or fourth quarter.
Yeah, no, good thoughts for sure. Yeah, it'll be interesting to see how we are affected as a market for sure. I mean, there's definite players in the game, but there's also others who are like, hey, let's wait and see what's gonna transpire.
But that goes back to your original point, which is when that happens, the people who were leveraged are going to create a great opportunity for people who want to get into real estate. There is and maybe that's 10% of the stuff out there. That is your sweet spot right there. When you can sustain with capital and these other companies cannot. I mean, it's just, then it comes down to the deal and you got to be patient and you got to be willing to, maybe bite the bullet for a little bit. But the weird thing with the stimulus package is even though unemployment is up, income is up as well, which is such a weird concept in our economy. So people feel great and they're spending money online and this, but that's going to run out soon. So when you think about when July comes around, I think there's going to be a very divided line between, looks like this is going to work and this other part is probably not going to work. And you're going to look in that area and see if you can find some opportunities.
Oh yeah.
I think that's a great point, Brian. Guys, like I've talked to a lot of my business clients and they all got the Paycheck Protection Program loans, the PPP loans. And so they've kept their employees, employed, and most are going to do that through the end of June. And then that money is going to start running out. Right. And so they're already talking about, hey, unless our business has kind of gone back up again by July or August, we're probably going to start laying people off. Right. And so you're going to have kind of a bounce back. So I think for me, and I've talked to architects and to real office building developers and people that own businesses that rent large office spaces, and every one of them is saying, "Hey, the office market is going to be different, right? We're never going to go back to the same old thing because people have realized, hey, we can sit at home and do a lot of what we used to do just as well sitting in the office. You miss some of that personal interaction, some of the collaboration that you get in the office, but they're going to make that up." I've got a client of mine who works for Microsoft. He's on the Microsoft Teams project. And they're blowing up, right? I mean, they're like busy as heck. So if you want to, buy into companies that are, going to take advantage, real estate related things involving remote work and access, and tech companies that are going to need a bunch of space and do all this different kinds of stuff. That's all good. But I'm not sure how the office market's going to shake out at the end of the day after all that.
Yeah, no, really, really good points to both of you. The office market for sure. I think things are going to be different. And Brian, back to the leverage question. There is going to be opportunities, but we can't take advantage of those if we don't have the capital. But then we need to have the capital and hold long term and not be over leveraged, so that when things like this happen, you can hold and sustain. But then also when there's those A type properties that do come available and you have the capital to take advantage of it, you can, but then you have to have that long-term approach, so that.
And also you got to look at what's going on right now. And maybe this is maybe in 2 years from now, we'll look back at coronavirus and say like, oh, you remember that Zoom thing we did? Oh, that was so crazy. It's so much better to be in the same place. But what about renting meeting space, right? People going to an office and renting out, just a table where you have the TVs and you can I need your meeting space for 1 hour, and then someone else can come in and I need your meeting space for an hour. And then there's in between the two meetings, we're going to make sure we clean it up with all the stuff we need to clean it up with. So I just think this is so drastic of a change in the world that we have probably, I don't know how long it's been since we've seen anything like this. A lot of people bring up a lot of different things, but this is such a drastic change that I feel like there's going to be drastic permanent changes moving forward. And the people that can take advantage of that are the ones that are going to be what you guys mentioned earlier. The people who took advantage of 08 and 09 are going to be the same people that take advantage of, 2020, 2021.
Yeah, no, great. Yeah, great thoughts. Really great thoughts. Brian, question, and that was a great segue to this question is, you and I had worked on quite a few projects in 07, 06 and 07. And we had worked on the land for the Adriana and had acquired that 08, really right before the downturn. As I was preparing this, just thought it would be good to get your perspective on what you learned during the downturn in 08, as you've acquired quite a bit of real estate over the years, but what you learned through that season and how you'd compare that season of your acquisitions playing in the NBA to now going through kind of this market.
Yeah, and I want to know how it worked with winning the world championship, right? Because that banner in the back's 08, right? So that was right there, right in that same time frame.
We were bringing hope to despair out there. No, wait. So the downturn happened October of 07 or October of 08?
08, October of 08.
Yeah. So since we won it, it's been all downhill from there. Now, the one thing, Andy, that it's easy for me to sit here and say, oh yeah, we did it, we fought through it and all that stuff. But I was an NBA player making $3 million a year. It's easy to sustain, the downturn when you have a guaranteed income of, money coming in. So we did do that, and you did a great job of changing the height limit, but that project took us 9 years to start, getting on board. And I think if interest rates go down and you can get great financing and you can explain to the banks, like, listen, this is the long-term thing, we need you to be on board, that this is going to take 10 years. We need great financing, for this to happen. If you can get a bank to do all that, then yeah, that's the easy part. The hard part is when banks call loans, 3 years later, they're like, no, we want to get out of here. You have to sell one part of the land to pay for the other part of the land. Like, that's the difficult part. I would not suggest buying things in '07 right before the downturn. I wouldn't suggest that to anybody, but I trust in you, Andy, and I know that you work really hard to get everything done, and everything you said you were going to do, you did. And so I have like a kind of a baseline trust that you're going to do the right thing. And I made enough money where I could sustain that downturn. And now we have, the Adriana, which we took advantage of, low construction costs to build that. But I'm not going to sit here and tell everybody, you want to jump in now. It's right before everything falls out. I would never say that.
Yeah. No, thank you. Appreciate that, Brian, a ton. And the truth is we work through a lot, right? I mean, that's just a lot of daily decisions. What's the right decision to make? We also were, like Brian mentioned, patient. It's like there's times, okay, we have an opportunity. We worked on raising the height limit on it. We worked on making what we had better. And we talked with the banker and said, hey, if we pay off one part, we want our prepayment penalty to be waived. So we were negotiating, and we had a relationship, and he agreed and said yes. So yeah, we did work through that. So yeah.
I think that's a really good point, Andy. One of the things I noticed from a lot of my real estate clients in '08, '09, some came through it okay. Nobody came through it great, but if they were a real estate developer or a builder or whatever, they got crushed. But some came through it better than others, and the ones that came through it pretty well were the ones that worked really hard on communicating with their lenders and talking to them all the time and letting them know what was going on, and letting them know the decisions you were making, letting them know how things were moving forward. And I think in tough times, if you've got a real estate property that is struggling or is not doing as well as you'd like, the worst thing you can do is not talk to the lender. This is what Michael would tell you if he could. But you want to talk to your lender, and you want to have a lender that is going to listen to you, right, and is going to help you. So it's tough. Like I have got a client right now who has a loan through people might be familiar with it. It's called a CMBS loan. So it's essentially a conduit, right? So you buy a property, you finance the property, and then that loan it's a commercial loan. And so much like the residential loans, it gets sold on the secondary market to a bunch of Wall Street investors with a bunch of rules, and it ends up somewhere, and you can never talk to the lender anymore. You just talk to this servicer person who won't do anything. And so you have zero flexibility when you have a hiccup in your property. There's nobody to talk to. They won't make any changes. It's really frustrating. So those loans are great when the economy is good. Those interest rates on those loans are usually pretty good. The terms are pretty good on them. But if you have a hiccup, now you've got a real problem versus if you'd gotten a loan from a portfolio company like a local real estate company like a Washington Trust Bank or another community bank who's going to listen and talk to you and help you, kind of work through these challenges that you might be facing. So having a good relationship with your lender and talking to them, and having a good lender who's been through times and will talk to you is super important.
Great points. It's so true. And that's part of what having Michael, hopefully Michael, we've just kept rolling. Michael can join us. He's having some connection issues, but that's part of having.
That's an investment opportunity, man. It's high-speed home internet, right? Because we're all going to be working from home, and you got to be investing in 5G. I don't know. I'm not a technical guy on that stuff, but man, 5G from home, that's what I want, right? So I can be doing all my stuff. I don't know. I mean, pretty much every Zoom call I'm on, one person gets blown up on their dang internet connection. So
I'm telling you, what happens to me is when I'm home and all the kids are doing their homework and they're on Zoom calls and they're just stealing all my bandwidth. I need to kick everybody off. There's only so much bandwidth when everyone's on Zoom calls on the day.
Yeah, it's brutal.
It's the new normal.
It's the new normal. It's totally the new normal. You're right.
Yeah. Michael, are you back?
Yeah, I was listening. I obviously moved into the house out of the ADU. So, but we're getting a little bit of shadowing. So
Okay, that's all right. So
Looks good, Michael. You got a
Yep.
better view than me. Mine looks a bunch of dark drapes, so it looks like I'm in a prison cell.
Yeah.
I kind of am, actually.
You're in like a Vegas hotel room. That's what that looks
Yeah,
like.
exactly. That's exactly where I'm like in a like hotel room. You know, what happens here stays here. That's all I can tell you.
what we have sun in Seattle. That's always a good thing, Michael. So it's so. Michael, did you hear some of our comments talking about, I asked Brian what he learned from the 07-08 season.
I heard most of it, Andy. So
Okay, got it. So we gave props really to you, Michael, and said, when you're going through a tough season, we need to stay, and Greg had brought up, you got to stay in close communication with your lender or your bank, and which we did. And I made the comment when Brian said, we paid off one piece, and we actually sold part of the project to pay off the other side. When we did that, we negotiated with our lender. We said, hey, if we do this, we're bringing value to the bank. Are you okay if we? And they waived our prepayment penalty because obviously the market was in turmoil. But we had a great relationship with them, and then Greg made the comment, Michael's at a great bank, Washington Trust Bank. You just got to stay in communication.
well, one of the things that we know being in this business is that no deal is going to run through its entirety the way it was crafted at the beginning. And so any astute organization and with good clients, or at least good dialogue with the clients, knows that you need to modify these things, because all these projections are simply that. And it's kind of interesting that, because we all know that leases change and properties have expenses and things come up all the time. And as long as you have a relationship with your bank, and it proved itself out on the whole PPP cycle that we just went through. A lot of companies work with some of the bigger banks, but they never had a banker. They never had a live person in many cases, and it created a lot of problems. And so the whole point of having a good dialogue with your bank proved itself out during the PPP cycle, and it's going to be the same whenever you have to restructure debt. I mean, I think I've done 3 loans in my entire career that have made it all the way to maturity without, and we're talking thousands of loans without some modification coming down. So it's just unrealistic.
Yeah, no, that's good. That's good. And we'll say, actually, that's a great segue into what are you seeing, Michael, on the PPP loans side of things in the banking industry? I know we talked a couple of weeks ago, and you said, I'm working on $1 billion worth of PPP loans.
Sure.
So
We ended up doing about $1.5 billion in Washington mostly, and about 500 million of that went into the Seattle marketplace for a lot of our operating company clients. We sit today at more than 3/4 of the way through the 8-week cycle that was originally defined, and less than 50% of the money's been used by our clients. And so people are doing what Greg was talking about earlier, and saying, I've got some, I don't know what's going to happen after the 8 weeks is up. Do I want to use all my money, or what do I want to do with some of the stuff? But people haven't been able to deploy the capital the way that they originally intended. And that's not even commenting on what the design of the program was at the beginning. But with the stuff that's going through Congress right now, and the extension of the use and the split from 75 to 25 to 60-40 being proposed, I think a lot of the businesses are going to be able to use this capital, not for payroll, but really to maintain the business, because payroll, it's the primary purpose of the Paycheck Protection Program. But if the business doesn't have a going concern to hire people back, that should be where more of the emphasis, in my opinion, is for the money. It's going to take a while for businesses to come back online. Back to what Brian was talking about, where we're really not going to know what's going to happen until Q1 2021. We have to keep these businesses up and running, because they keep everybody employed, they keep everybody spending the money, and they keep the people paying their rents, in an apartment example.
yeah, no, yeah, great points, really great points.
Hey, Michael, I was curious, like what, what I've been, seeing, and I'm curious how Washington Trust is looking at it, is for people that are going out for real estate loans right now, the lending standards seem to be a lot tighter, right? And if you can get them, and so they're requiring, at least in my anecdotal experience, more capital, right? So lower loan to value numbers, and more reserves, things like that. What kinds of stuff are you? I'm curious what kinds of stuff you're seeing if somebody comes in and wants to get a real estate loan right now.
So, we've been on the conservative spectrum since most of our clients aren't pushing the leverage. And, we want to see a 1.3 debt coverage ratio going in before COVID, during COVID, and we're still looking at the same metric. And we underwrite it, even though the effective rate isn't going to be as high as 6.5%, but we stress the deal. We might give somebody a 4% rate over 5 or 10 years, but what if there's a reprice that goes on mid-cycle, and can they support a 6% and maintain a 1-to-1 debt coverage ratio? So we haven't changed our internal policies, and we've done a couple of good-sized real estate loans. I had 3 large apartment buildings close in the last 35, 40 days for clients. But what's happening are the external things. We have a lot of capital to lend. A lot of the other competitors in the space, be they banks or CMBS or other third-party lenders, they've pulled up stakes and they're just not making loans because they can't sell those loans into bond pools and create liquidity for themselves. So you're seeing a lot of stuff coming back towards banks because they have the money to lend, and all the other players' pockets are bare right now. So we're just sticking to our knitting, which is making good loans from the beginning, and it's going to continue to serve us well. So.
Yeah, I think some of your competitors who were a little more aggressive are pulling back, right? And they're coming back to your spot or worse. Because at least that's my experience. It's if you want to do a real estate deal now, it's harder.
Yeah, a lot of the credit unions locally in Seattle were very aggressive on lending on multifamily properties, and they've pretty much just stopped. And I'm hearing stories where they're re-underwriting last month's rents and adjusting the rents. Adjusting the loan amount and creating much more reserves. We haven't done any of those things. So our clients have a balance sheet behind them, and we take their personal guarantee on every deal. So we don't tie up their capital in the deal, and that's just a philosophy that we follow.
Yeah, that's part of what I was talking about earlier. Andy was mentioning that if you have a good relationship with a good bank who understands how to loan money over a long period of time, that's great. And some of the other larger lenders, more institutional lenders, aren't as flexible and tend to make it a little more challenging. And I know their underwriting right now is a lot tougher than it used to be. I had a couple clients with some deals in the pipeline for financing that had to pull the plug because the lenders did, which is what you said, right? They changed the deal on them kind of halfway through because of what's going on with COVID.
Well, if you're not lending your own money and you're relying on the bond market to fund your loans and rebuild your capital, that's going to be a very scary situation for the next 12 months because the investors that buy those bonds are all over the map right now, and the pricing is all over the map. Even though rates have come down for the 10-year Treasury materially, you haven't seen the pricing come down in the same amount of money. So people are just holding back and getting more conservative.
Yeah, no, it's true. Yeah, I'm seeing right, Michael, debt coverage requirements going up a bit. Reserve requirements are going up. So it comes back to the leverage. It be at least lower risk on the lower risk side of things, and just not knowing boundaries and knowing what's a good deal and building all the right projections and having the right risk profile per deal.
Well, as a lender, my favorite deals to do are the ones that are 30, 40% vacant, and there's huge upside and there's a huge discount being employed to acquire the property. And that's really where you build wealth for people. So, as long as the people have the adequate resources, we don't mind taking a jump in and looking at that kind of an opportunity, because we know over time that that's going to outpace any returns that you would make just over the current cash flow and locking in your rate for 10 years. There's a much more cushion. There's a cushion with the margin of error when you can buy on the cheap, build the value and get the cash flow up, even in these times.
Yeah, no, that's good. Good thoughts, Michael. Greg, I'll ask you this this question. You're one of the most active syndication attorneys in the Northwest, and we've talked about it. But what are you seeing a lot of your clients doing? What decisions are they making?
Yeah, so that's an interesting question. Some are a little nervous, but others are taking the attitude, hey, this is an opportunity, and they want to be well capitalized. So we have 3 clients right now who are raising funds, funds to go out and look for distressed properties, distressed opportunities, good purchase opportunities, both in the apartment and commercial sectors, right? So I think there's an appetite there for people that realize, hey, if we can find these properties that are struggling, that are at bottom good properties, they just are going to have a tough time for a year or two, then we can go in with some good capital. We can get really good rates right now, good financing if we have the right amount of capital to back it up, and we can tie up a nice property and then and then either rehab it, right, if it needs some TLC, and then re-rent it and have it ready to go, or just buffer some vacancy or other stuff for a period of time, so that like Michael was saying, in a couple of years from now, this COVID thing is a temporary thing, right? I mean, how temporary is it? Is it temporary by the fourth quarter? Is it first quarter, second quarter next year? I don't know. But at some point they're going to figure out a vaccine. Some point they're going to figure out how to take care of it, and people are going to feel more comfortable, and things are going to go back. And there'll be some changes, like Brian was saying, in my mind anyway. This is just Greg's opinion. There'll be some changes, like we talked about with office markets, and maybe you're not going to go to a bar, like Brian was saying, so much and bumping shoulders with everybody as much as you used to. But by and large, business is going to get back to work. And I think, then we get through that period of time, and you're going to have some really good investment opportunities that you will have been able to capitalize on if you've got that capital. So I think the smart people right now are looking for those opportunities, and they're raising capital. If they don't have it themselves, they're raising it from other people, like the Bryans of the world, to put together a program to go out and look for these opportunities as a group.
Yeah, no, great thoughts. Michael, we'll ask you this question on what cities, neighborhoods, markets are you seeing currently investors interested in? And any ones that come to mind?
Well, first off, anything outside of Seattle, that's the first cut. And but I'm seeing stuff like, anything that's associated with light rail. Montlake Terrace, we have a client doing a very large project on the freeway there because light rail is going on. And even in Angle Lake, SeaTac down there at the end of the light rail station. We're going to densify Seattle much more than we have in the past over the next 10 to 20 years. And anytime you can create, transportation hubs, I would get in there if you can afford it. I would get just outside those perimeters as a safety net for yourself to making an investment, because, over the last 10 years, especially as light rail has come about, you've seen the zoning increase from single family to much higher density stuff. And so if you can buy an investment, make it pencil, and then wait for progress to come your way, I would focus in on Seattle where there's transit hubs. We had a client, I think it closed in January, but they had a piece of property that Sound Transit took down in downtown Redmond, and Sound Transit ended up paying them 50% more than the appraised value was for the property on the cash flow, how valuable it was. And the client didn't want to sell it, but it was an eminent domain thing. And they eventually agreed on a price because it was going to be worth 3 times as much in 5 or 6 years if they could have developed the site.
Yeah, that's a lot. That's a lot.
Yeah.
Michael, so what do you see happening in the rate-wise capital market, financial markets coming here in the next 6 months? What are your thoughts?
I think treasuries are going to push rates even lower. it's not unreasonable to think another 25 to 50 basis points, the effective borrowing rates for people, because as I was talking a little bit earlier, when the 10-year treasury, which has dropped probably 100 basis points or 1% in the last 60, 75 days, the effective mortgages that get written off of those hasn't dropped by the same amount. And historically, the average spread on a mortgage has been about 1.8% over whatever the underlying security is. It's been as high as 2.7, 2.8 times, and that's just indicative of the caution that people are taking. But with all the trillions of dollars that we've extended out as the government can't pay the debts at the old rates that they have outstanding right now. So they're going to have to reissue new treasuries, which is going to lower the effective rates for everybody. We just have to get through the noise of the summer and maybe through the election, but we can't afford to repay back all this money unless the rates are lower than we are right now, because our tax base is off. So those are some of the external inputs to why I think rates are going to be going lower than they are even now.
Yeah, no, that's good.
Yeah, I'm curious because Brian, you're back in Boston area, right? So what's the market like back there compared to like Seattle? I mean, is things quiet? What's going on?
I have no idea. I'm most of my stuff is outside of Boston. I have just my own home here. I don't really have partners out here I do work with, and I'm not doing small stuff anymore. So anything I do, I'm going to have people that I work with and partners and stuff like that. So I don't know what the deal is here. I do know that it's probably not as booming as Seattle. Ours is probably more steady, where you guys have the influx of all the tech in Seattle. And I know just from talking to Andy that Seattle has just been insane the last 15 years.
So, but I don't know off the top of my head, is Boston open up? Is it still pretty close down?
From COVID? No, we're phase one. We still have, maybe on Monday we'll be on phase two. So we're a long ways away, and they keep putting it out and bringing it back. So you can get a haircut, maybe no haircut. And now you can go to the park, no more going to the park. So we're when it comes to this type of stuff, we're a very conservative state. So I think all summer will be different. I'll give you just a quick example in my life. I run basketball camps in the summertime. They're all gone. They're all canceled. I had a choice. I could be outside and everyone could be 6 feet apart during basketball games, which I was like, I don't know how to stress defensive intensity and pressure when you have to be 6 feet apart. So we basically just wrote all those off. So this summer, it's nothing, but at home, just chilling. But the NBA is coming back. So I'll be working on the NBA all from July 31st all the way through till October. So just a weird schedule for me.
Yeah, it is. It is just bizarre. I'm looking forward to having some sports back though that we can watch.
Yeah, no doubt.
Absolutely. Guys, so we have a couple of questions we didn't get to, unfortunately, but that's, because I want to jump into some Q&A. So these are some of the top questions that have come in. So we're going to go a little over. We're going to do about 6 minutes of Q&A. We said 10:55. I figured we might go over by about 5 minutes, everyone that's on. We have quite a few people on. So we're gonna go till about 11, everyone. So if you can hang around. So question number one, what would you say to an investor with a very negative outlook on economy in next 6 months? I've heard both sides, very positive and very negative. What are your thoughts? Michael, we'll give you that one.
Well, I mean, you better believe how your view of the world is. I mean, there's money to be made in up and down times. I mean, I never counsel anybody to believe what I believe. I believe them to form their own opinions and go with that, because they have to sleep at night and they have to invest their capital and they have to make decisions all along the way. And whether you think it's going to be up or down, you can still make money in those cycles. You just have to change your plans.
No, that's good. Okay, Greg, what do you think of this one? You made the comment on office. If offices stay closed, don't you think more big business will go to the remote workplace? If this happens, won't commercial prices drop drastically?
Yeah, I do. I think, I don't know. I wouldn't say, I guess it depends on the markets in my mind, right? So if you look at the greater Seattle market, Bellevue market, pretty much all of the office tenants that I'm talking to, I have probably 20, 30 office business clients I've talked to in the last month and a half. 100% of them have said they're not going to need as much office space going forward. They figured out that they can do this differently, and they realize that, and they're going to do that. And the architects, I represent several architecture firms that do a lot of office space work, and they've all said, hey, this is what all their clients are talking about. So there's no question in my mind the demand for office space is going to be less going forward because people now realize they can work remotely and do it effectively. And so that's going to, demand is simple economics, right? If demand is less, you're going to see prices come down a little bit on those things, and which means probably less new office buildings are going to get built, and they'll adjust, and that might happen. So if you're a tenant and that's probably a good thing for you, right? Is that you can look to renegotiate some lease rates or maybe get a little relief on some of the higher rates that you've been at. If you're a landlord, that's not you're not a happy camper right now.
Yeah, no, it's very true. I bet we'll start seeing more mixed use apartments being built with a smaller component of office. Brian, go back to your point. Hey, come rent out that conference room for an hour, 2 hours. So just less office. Okay, next question. How do you think an administrative change in the executive branch of government would affect the economy? Drastically or minor, how would rates get affected? Michael, I'll give you.
Hey, take that hot potato, man. There you go.
Mike, you can take that one. I would have passed it right to Mike too. Go ahead, Mike.
Well, whether whoever is sitting in the Oval Office in 6 months, I don't think they can fight the argument that rates need to be lower because the debt's already been extended out there. We need to be able to afford it, and there's just not enough. Even if we get a brand new president and there's 4 years of an election cycle, it's going to take a wholesale change to change any of the economics to support this stuff. So I don't think the change in the executive office is going to change dramatically the economic outlook. There might be fewer tweets, almost certainly, but the fact of the matter is all this stuff is baked in right now. The momentum is going, and it's going to take a couple years for the economy to recover. And whether or not the Republicans or the Democrats are in the office, it's going to be interesting. On a personal note, one of my clients, his uncle is Weld out of Massachusetts there, who's running against Trump. And he has a very slim chance to win, but at least he's putting up a good fight. So
yeah, see, and that's why me and Greg, we pass the ball to the superstar at the end of the game. We know.
That's funny. So one quick comment that I'll make on, I know a lot of bigger projects in Seattle and on the east side, just around in our area, that are continuing to go. They're continuing to move forward. So there are deals that are happening. Okay, Brian, we're going to give this one to see what you think of this one. Given the large amount of capital already organized, funds, etc., which is a different situation than 08, 09. What are your thoughts on how this affects being able to identify and actually transact on properties at a discount?
So translate that for me, Andy, in English.
I know. Okay, so
just give me make it simple for me to understand the question.
So
not like Mike.
Me neither. So large amounts of capital
are
being organized right now.
Okay.
I think he's worrying about, like, there's a lot of buyers, going to be a lot of buyers, right? And so you're not going to get the discount like you thought you might. Because
I disagree. I think for people who have small businesses or even like mid-sized businesses that maybe they want their own office space, I think they were priced out of the market. And I think those individuals will say, you know what, now is a great time for me to buy my office space that fits my needs. So I think there'll be a lot of small businesses that look to purchase their own office space at this point. That would be my guess with the influx of office space. Or I don't think they'll be buying Class A, but I think they'll be buying something, and they'll look at it like this is a great, just like what you said, you've got to have real estate in your portfolio. It's a great way to add real estate to your portfolio if you are a small business and you find a place that can suit your needs. That was a buzzer at the end of the buzzer.
Sunk it from the 3-point line.
Yes.
Okay. Last question, real quick, Michael. Are banks giving investment property owners some leeway on their loan payments? Are banks requiring payments or giving consideration for COVID-related delays?
Yeah, absolutely. We implemented a 90-day deferral on clients that needed it, and so we talked to a lot of our clients and gave a 90-day deferral. And we have depending on what the medical outcomes and what phase we're in, we've got it built in to do another 90 days for this stuff. And the key to this is normally when you do a deferral, it's a criticized asset, and the regulators just get all over your back. They came out and said, we're not going to treat this from an accounting standard like we do a normal. So the banks have been pretty flexible at providing these things. There's, we've got about 400 SBA loans, for example, and the SBA is paying and forgiving all the principal and interest payments for the next 6 months on all our SBA clients. So that's a windfall. So they're still continuing to make their payments. We're just applying 100% of it to the principal. So there's different angles going on this stuff, but we're as a rule, if your business is impacted by COVID, we're going to give you at least one 90-day deferral and possibly two, just to get back up, because we have enough capital to be able to do that and not impact our earnings. We want our clients, whether they be businesses or real estate properties, to continue going forward, because as you all know, banks never want to take over a piece of real estate or a business, because they are not good operators of those things. So
yeah, no, that's good. Well,
Andy, I got a call. I got to jump on a call. I'm really sorry, but hey, good talking to all you guys.
We'll say
and Mike, you're a star.
We'll wrap up. Actually, guys, we'll wrap up. Guys, thanks for joining. Enjoy the rest of your day.
all right, thanks, Andy.
Thank you. Thanks, Andy.
Hey guys.
Thanks, guys.
Nice to meet you guys.
Yeah, travel safe, Greg.